Hi folks, welcome to this video which reviews one of the concepts in the earlier part of the course that focused on business combinations and the purchase of net assets, which is one way to form a business combination, versus the purchase of shares of the investee company. So let's have a look at this question. Abdul and Lana. You can see here on June the 30th, year 2, we have some separate entity financial statements. And you'll notice that on July 1st, year 2, the day after these statements were prepared, Abdul affected the business combination by purchasing all of Lana's assets and all of Lana's liabilities. And they paid $58,000 in cash to do it. Now, all of Lana's assets and liabilities would be sitting at their carrying value. But Abdul, the new owner, paid $58,000 in cash, not to get carrying value. They picked up fair value. And it says here that all of Lana's assets and liabilities were at fair value. Assets and liabilities were equal to fair value, so that means carrying and fair value were equal for all except for 3 items. Inventory, which was valued higher, so fair value was higher because carrying value on Lana's books was $81.50, but fair value is $10,050. Plant assets, you'll know, are being carried by Lana at $66,350, but Abdul thought they were worth $70,100. So that's the fair value that Abdul would pick up on this transaction. And for long-term debt, Lana has its debt sitting at $40,100, but Abdul thought it was even less than that, which is a good thing because they're buying less debt, and that's $33,800. So now what we wanted you to do, assuming that we had a purchase of net assets, is to record all the entries in Abdul and Lana's books to record the transaction, and then in part B, do the balance sheet for Abdul and Lana, right? So notice, even though this is a business combination, we're not doing a consolidated statement. Why? One big reason is that Lana's assets and liabilities are now going to reside with Abdul. Lana is going to be out of the play, checked into the boards, as we say, gone. Why? Because they have no more assets within which to operate their existing business. So they'd have to decide, do we want to take the cash we have and start another business, or do we want to pay out our shareholders their dividend and just wind up and not do anything? Their call. But that's the idea. So we don't do consolidated statements. Don't forget, consolidated statements as soon as a subsidiary company continues on, and in this case Lana's not. So that's why we're doing separate entity statements for Abdul and Lana at July the 1st. You'll notice that we're not going to do an income statement. Key reason being that there's no income that's going to be earned between the two because Lana, again, is going to go bye-bye. It's going to go away, right? So there's no income statement considerations here. So now let's begin how we would handle this under the purchase of net assets. So let's have a look at our solution. You'll notice here, again I repeat, because it's a purchase of net assets, Lana's likely not going to continue to operate, so we're not doing consolidated statements. So now, at the date the two become related, which is July 1st, year 2, what is Abdul going to do? Well, Abdul is going to take on all the cash and receivables, inventory, plant assets, and all the debt, current liabilities and long-term debt, onto their books at fair value. Don't forget, they bought Lana's fair value, and they paid $58,000 in cash for it. So the one thing you got to check first is any goodwill created on this transaction? So to figure out if there was, we're going to compare what Abdul paid to what they actually got in fair value. Well, we know the fair value of Lana's assets, right? How do we know? Well, let's go back to the question. The question told us that carrying value and fair value were the same except for inventory, plant assets, and long-term debt. So what happened? Abdul picks up the cash and receivables at their carrying value, which is the same as fair value. They pick up inventory, not at carrying, they pick it up at fair value, and they pick up the plant assets at fair value. They also pick up the long-term debt at fair value of $33,800. not 40,100, but they do pick up the current liabilities of Lana at 27.6. All right, so that's why you see in these numbers we've got a combination of what some students would say is carrying value and fair value. But to Abdul, all they said is at the date we became related, we offered 58,000 because we knew the assets had carrying value and liabilities. Some of them were still at carrying value, which is fair value, but some of them had a fair value which was higher. We assessed a higher value. So therefore, what we have is we have the cash and receivables at their fair value, which is the same as carrying. Abdul would take onto its separate entity balance sheet the inventory, not at cost, 8150, or not at carrying value, 8150, but at fair value. They take on the plant assets at fair value, right? The current liabilities and long-term debt. So when we add together all of these assets at the carrying, which is equal to fair value for the cash and receivables, 10,050, which is the fair value of the inventory and the fair value of the plant assets, we get 100,300. Similarly with the liabilities, the only liability that has a fair value different from carrying value is the long-term debt. So we've picked that up at 33.8, and the carrying value and fair value for the current liabilities in Abdul's estimation is the same. So we have the fair value of liabilities at 61.4. So the fair value of the net assets, all of which are identifiable in our case, is 38.9. So if we compare that 38.9 to what we paid, the amount in excess of the 38,900 in fair value of net identifiable assets must be our goodwill. So that's why I asked you to do goodwill first. So you set up everything that you as Abdul picked up, including the goodwill, because you paid more than the fair value of the net identifiable assets. You pick up the current liabilities at their fair value, which happen to be the same as carrying value for Lana. You pick up the long-term debt at the fair value you assess for that long-term debt Lana has, and you credit your cash if you're Abdul. Why? Because that's what they paid to get that. What does Lana have on its books? Well, guess what? That cash you paid out, Lana picked up. Lana no longer has current liabilities and long-term debt on its books, so it's debiting those liabilities. Notice that while Abdul picks them up at fair value because they paid based on fair value, what's Lana doing? Lana's getting rid of them at their carrying value, right? So we're taking them off Lana's books at carrying value, as well as the cash and receivables, inventory, and plant assets. So we see that the left-hand side and the right-hand side don't balance. We'd be a little light on the credit side. So what do we need to do? We need to balance it by plugging a gain. So what that means is that when we compare the amount of cash that Lana got to the carrying value of the net identifiable assets and liabilities that it gave up, we see that we have a gain on the net assets of $31,050. So you can calculate it or you can just simply plug it. All right. So now if we had to do the balance sheets of both entities, don't forget you had on your statements, right, 93,000 for cash and receivables for yourself, right? Don't forget these statements here were on June the 30th year too. So you have to make sure that you include all the July 1st stuff in there, right? Meaning that you have to remember that in this 93,000, for example, Abdul hasn't yet paid the 58,000 because this is the June 30th, the day before they paid it. But you're doing a balance sheet on July 1st, so you have to take the 58,000 out, right? So there's little things like that you have to be mindful of. So if we go back to the solution, we've picked up onto our separate entity balance sheet. If we look at this entry, we've picked up 20,150. That's why I've got the blue matching blue, but that 58,000 is what we paid out. So you can see everything we did the day before or everything we did July 1st year 2 has to be factored into the statements at July 1st year 2 after we affected the business combination. So now we're going to have 55,150. We've got our inventory again that we pick up our own at carrying value, and we pick up Lana's at fair value because don't forget we set it up at fair value again, following the blue letter or the blue numbers with the blue numbers. We get 70,550. We took up our carrying value plus the fair value of Lana's plant assets, which again blue on blue, 306,100, and again the goodwill we calculated, and we'd get total assets of 450,900. Now let's go ahead and do the liability and equity section. So again, don't forget we're picking up the current liabilities of Lana at fair value and adding it to our carrying value, which is 93,000 in total. And again, we're picking up the long-term debt that Lana had. They had it at 40,100, but we as Abdul thought it was only worth 33,800, so that's what we paid for, a lesser liability. So we pick it up at that amount and add it to our carrying value, so we get 128,050. Now again, don't forget with the common shares and retained earnings, we are only taking ours. We are only taking our common shares and retained earnings, and there was no change to that. So we can see here we're only picking up our common shares and our retained earnings. So here what we have is those two items in here. So we have liabilities and shareholders' equity total on Abdul's balance sheet at 450,900. What does Lana's look like? Well, don't forget, if you go back to the entry that Lana made, what Lana did here is, don't forget, they took in cash of 58,000, so we've got that cash there. But don't forget, that's the only asset they have. Why? Because they dumped all of their assets at carrying value because they're now sitting on Lana's books. Don't forget, they're all here on Lana's books, right? So we've only got cash of 58,000. We don't have any liabilities. Again, those are now sitting on Abdul's books, right? They've come off Lana's books. We've got common shares and retained earnings. We've got common shares that Lana had of 40,500. Again, we can see that right here. But notice we didn't pick up just a deficit that they had in retained earnings. So that's your retained earnings debit. That was on June 30th, year 2. The one thing you're going to have to remember is, don't forget, at the date of the business combination, Lana booked a gain on the transaction. So when they sold all their net identifiable assets for 58,000, they booked a gain. So that gain gets closed out to retained earnings before they do their balance sheet. So that means that the gain is going to make retained earnings go up. Don't forget what you did in your earlier accounting classes, right? You would have debited the gain to close it out, to zero it out, and that would have found its way into through retained earnings by crediting the retained earnings when you closed up your income summary account, right? So therefore, we're going to increase our retained earnings. So it's now going to be, it was a deficit, what we had before, which was, let me just go back here and double check it, 13,100 deficit, right? So that would have been bracket 13,100, but then don't forget we have to add in, so that's like a negative there, right? And we'd have to add in the gain, because don't forget that gain increased your retained earnings, right, when you closed out. So if you did that math here in the bracket, you'd get 17,950 as your ending balance for retained earnings on Lana's separate ending balance sheet. So you can see their balance sheet will now balance to 58,000. Now in the next video, we're going to have a look at, what if we didn't do a purchase of net assets as Abdul? What if we actually went to the shareholders of Lana and we made an outright purchase of the shareholders of Lana's common shares? That's going to mean Lana will continue to operate and will prepare consolidated statements. So let's stay tuned and go to video 2.